And thank you everybody for attending here virtually. It really is my pleasure to be able to speak and present to you. So without further ado, because I know we only have half an hour, today's presentation is entitled Tax and Estate Planning in Action. I know the theme today is stories that sell, and I've intentionally included a couple sales strategies here with case studies that I think have been very effective in the right situation in terms of actually generating sales. So without further ado, let's get going. So some of you may have seen this slide before. There's a lot to this slide, and I almost never speak to all the elements of this slide because there's too much. But what we try to do here is highlight all of the potential benefits that seg funds and GIAs, and this is very important because I do want to talk about GIAs at the very end, can offer. Now, for those of you who are not familiar with GIAs, or maybe there's a little different terminology depending on what you've worked with before, GIAs are just basically the insurance company's equivalents of a GIC. So, 3-year, 1-year, 5-year GIC, same idea for a GIA, just insurance companies offer it. But the nice thing with GIAs is almost all of the benefits that apply to seg funds also apply to GIA. And the big thing, obviously, is being able to name a beneficiary with non-registered funds. So there's a lot here on this slide. Some are province specific, so for those of you in Quebec, seg funds are the only way to name a beneficiary both for non-reg and registered assets. You can't do that with a mutual fund or stock portfolio in Quebec. One of the things I haven't mentioned here is for those individuals in Ontario, seg funds and GIAs offer an additional benefit that up to $100,000 can be invested for those individuals who qualify for ODSP, Ontario Disability Savings Plan. So that's a nice way to put some money aside for those individuals and not disqualify them or disentitle them from ODSP benefits. But I do want to focus on a few, and I think we know a couple of the headline ones. Again, you name a beneficiary, the assets flow outside of your estate, all the benefits that come with that, quick death benefit payout, additional privacy, reducing probate fees where they're applicable, or other estate administration fees, the potential for credit protection, et cetera, et cetera. But I do want to focus on a couple here. The annuity settlement option, the RIF successor annuitant, the irrevocable beneficiary strategy, and again, last but definitely not least, GIAs. So the annuity settlement option, this is perhaps our most popular strategy. And again, not for everybody or every situation, but in the right situation, this can be really attractive. I use kind of a simple but realistic and real life example that we see on a regular basis where this might apply. I'll take a step back just to kind of give you the context or the landscape where this might be applicable. It's very simple. A situation where a client comes to you and says, for whatever reason, as part of their estate plan, there's a particular beneficiary where they want to control from the grave. They don't want a particular beneficiary to receive a lump sum. And there could be whatever reason for it. The child could have financial issues. The child could have marital issues. The child could have substance abuse or mental health issues. Maybe there's creditors going after that child. For whatever reason, the client does not want to give that child or that beneficiary a lump sum. So the number one strategy that probably comes to mind is a trust, and trusts are great estate planning tools, no doubt about it. There are some downsides to a trust. You have to go see a lawyer to draft a trust document. You have to name a trustee. You may have to pay trustee fees, and they're very inflexible once they've been set up. There's an additional disadvantage that's going to appear next year as well, too, in terms of enhanced reporting. And I have a slide that talks a little bit more about that in detail for you, so just hang on to your hat for that one. So you have trust as a great estate planning tool to control from the grave, but another estate planning tool, so another arrow in your quiver, another tool in your toolbox, is the annuity settlement option. And I want to be very clear about this. This is not a product. All this is we've modified the beneficiary designation on traditional life insurance policies, seg funds, or GIAs, where instead of a beneficiary receiving a lump sum, they will get an annuity as determined or as selected by the client. Okay. Again, it's not a product. It's just an amendment of the beneficiary form. It's really simple. On a normal beneficiary, you name the beneficiary, you name their percentage of their entitlement, but there's 2 extra boxes. lump sum or installment. So if you want the beneficiary to receive a lump sum, you tick off the a 15-year term certain, it's your prerogative. And it's completely free, just like any other beneficiary designation. And just like any other revocable beneficiary designation, you can change your mind at any time. So it's extremely flexible. And in fact, there are a lot more uses to the annuity settlement option that might seem initially obvious. So let's go through an example. We have Elizabeth. She has two kids, Ken and Christina, and her estate plan is very simple. When she passes away, she wants everything to be divided equally between her two kids, Christina and Ken. Christina lives in Canada, is very good with money. Elizabeth trusts her, has no issues with her. Ken, unfortunately, lives in the States and is not great with money. For whatever reason, Elizabeth does not want to give Ken his 50% as a lump sum. She would like to get his share. She would like him to get his share and 10-year installment payments, or using a 10-year term certain annuity. So, like I mentioned to you before, this is another option, another alternative to a trust, so something else you can present to your client. It's free, easy to do, revocable, and completely flexible and reversible. And what will happen is on Elizabeth's death, 50% of the death benefit will go to Christina in a lump sum, and Ken's 50% share will be used to buy an annuity, in this case, a 10-year term certain annuity, based on annuity rates at that time. It is a brand new sale. So there is a commission that is generated by it. Again, it's not huge when it comes to annuities, but it's a regular annuity sale. And once that annuity is set up for Ken, Ken cannot monetize it. He cannot assign it, transfer it, or commute it. The only thing he can do is he can name a beneficiary on the annuity if there's a guarantee term, or with the term certain annuity, in case he dies prematurely. Now, again, I mentioned to you a lot of flexibility. Just to give you a few examples of the flexibility this product offers, if Elizabeth sets up the contract today that way, with Ken getting his 50% share in a 10-year term certain annuity, let's say she lives another 5 years, and over those years, she feels like Ken has become more responsible, she can give Ken part of his beneficiary entitlement as a lump sum and part of it as annuity, or she can give it all as a lump sum. It's completely flexible. And again, there's obviously no issue distinguishing between Ken and Christina. Furthermore, if for whatever reason Elizabeth says, you know what, I'm worried about what happens if Ken dies prematurely, so before the 10-year term certain annuity expires, as to who's going to get those remaining guarantee payments. I don't want Ken, for example, to pick his wife or Elizabeth's daughter-in-law, but let's say for whatever reason, Elizabeth doesn't have a good relationship with her daughter-in-law. Let's say Elizabeth says, well, no, if Ken dies early, I want any remaining guarantee payments to go to whoever Elizabeth chooses, let's say a grandchild, so the daughter of Ken. She can actually designate who the beneficiary of the annuity is in case Ken were to die prematurely. So that's how far you can control from the grave. Again, all free. And then when the annuity was set up for Ken, it'd be like the granddaughter was named as irrevocable beneficiary. Something else I just learned in the last year was someone asked me, well, John, what happens if for whatever reason you just don't want Ken to get the money right away? You're okay with him getting a lump sum, but you don't want him to get it for, let's say, 3 years down the road. You can actually do this. You can buy a 3-year deferred annuity, just to show you how flexible this can be. Now, with a deferred annuity, you just want to keep in mind that when that annuity is bought for Ken, he will receive a tax slip every year in those first 3 years, so he must have the cash to pay the tax. But again, just another example of the flexibility. And lastly, but definitely not least, this works with non-resident beneficiaries. And as I'm going to take a step back for a moment, as a general point, when you name a non-resident as a beneficiary with a seg fund or a GIA, and they receive a lump sum, there's no withholding tax on non-registered funds, lump sum payments, no withholding tax regardless of where they live, and they get the money quickly. Now, with the annuity settlement option, there's an additional benefit with non-resident beneficiaries. Manulife will do all the tax remittance and withholding to the CRA and issue the NR4 slip to the non-resident beneficiary here, Ken. And that's a huge benefit to a potential executor who would have to do that on their own if the executor was paying money out to a non-resident beneficiary. And I'll give you an example where non-resident beneficiaries are a real risk for personal liability of an executor. If I was the executor of an estate let's say of Elizabeth's estate, and the assets that flow through the estate. And Ken was a 50% beneficiary and Christina was a 50%. Well, as I accumulate Elizabeth's assets, I'm not going to pay them out right away because I need to make sure I have paid all the creditors. And I also have to file the last tax return for Elizabeth called the terminal return and get a clearance certificate back from the CRA. The clearance certificate just basically says that her taxes have been paid and she's in good standing. Until I get that, I'm not going to pay all the money out to the beneficiaries because then I could be personally liable for the taxes owed or the money owed to the creditors. Well, as I hold on to those funds while I wait to pay off the creditors or I wait for the clearance certificate, I'm probably going to put the money in a high interest savings account or something like that. Well, any income that's earned, half that's going to belong to Ken. And I need to remit and withhold the withholding tax to the CRA as the executor. And if I don't, I'm personally responsible. I have a personal liability issue. And I have to issue the NR4 slip to Ken. So again, by having assets flow outside the estate, in this case, having an annuity issued by Manulife, it can actually save a lot of work and potential liability to an executor. Contract setup would be very easy. Elizabeth would be the owner and annuitant, and Ken and Christine would be the 50% beneficiaries. And again, Ken would get his using the annuity settlement option in the form of an annuity. And in case you have clients who are interested in this and you want to kind of show them that this is well accepted in the community, Hall & Hall, one of the top law firms in Ontario, estate planning law firms. In fact, Ian Hall just won an award for lifetime achievement for the Ontario Law Society to estate law. They actually talk about using annuities. They talk about Manulife investment management, and they specifically talk about the annuity settlement option. So this is found on their blog. I did not pay them to do this. I was actually pleasantly surprised to see this. This might be a great marketing tool for you if you're interested in this strategy to share with clients, again, just to enhance the credibility of this strategy. And we've seen this all the time. In fact, the origin or genesis of this strategy is because there was a lady who came to us, a similar situation to Elizabeth. She was in her 70s and her clients were in her 50s, and she asked us if there's anything we could do so that her children would get installment payments instead of a lump sum. So these are real life cases, and again, probably our most popular strategy. I did mention to you before earlier on, I kind of teased you that when you talk about annuity settlement option and trust, there's another reason why trust might be a little bit less exciting or attractive, and that's because of the enhanced tax reporting rules that are going to start next year. Basically, any trust, subject to a few exceptions here, a trust that's been in existence for less than 3 months or has less than $50,000 in assets with publicly traded securities or cash or government debt, or a graduated rated estate or qualified disability trust. So unless you fall into these exceptions, and the majority of trusts will not fall into these exceptions, every trust is going to have to file a tax return starting next year. Even bare trusts, and they were initially excluded from the legislation. Currently, if you have a trust and the trust flows all the income out to the beneficiaries, so there's no income left in the trust, a trust doesn't have to file a tax return because there's no income to report. Well, starting next year, even if there's no income to report, CRA wants the tax reporting done. Just like with the principal residence exemption, they didn't change the principal residence exemption rules. You can still qualify and pay no tax when you sell your principal residence, but CRA wants that disclosure because they want to make sure people are not engaged in fraudulent activity. So with the trust rules, when it comes to tax reporting now, there's going to be additional compliance, delays, and costs. And the CRA wants the name, address, date of birth, and SIN of every settlor, of every trustee, and of every beneficiary, even a contingent beneficiary. So if you say the beneficiaries of a trust are my 3 children, and if one of them predeceases me, then it goes to their children or their issue or per stirpes, then you have to list all those potential grandchildren or great-grandchildren as well too. So you can see that this is a little bit of a pain in the butt and might tip the scales a little bit more in favor of the annuity settlement option if you're kind of on the fence as to what strategy to use. So keep that in mind. And there are penalties for failure to file as well. So the second strategy I want to talk about quickly is I've talked about a strategy about gifting at death. controlling from the grave. Another very popular strategy nowadays, especially with real estate prices so high and mortgage rates going up, is gifting while you're alive. Okay, so you'll see lots of articles about it. Some people use the term never money, where parents might want to give money that they know they'll never ever need to their children or grandchildren now before they pass away, so they can benefit from it now instead of waiting for when they pass away, which might be another 10 or 20, 30 years, because usually the kids or grandkids could use the money more now as opposed to down the road. And again, these are situations where the parent or grandparent doesn't need the funds. So a lot of people are gifting money. And the great thing about Canada versus the US, in the US, there's something called the gift tax. So if you gift money to certain individuals, you could pay tax on that. In Canada, there is no such thing as gift tax. In fact, you can actually income split if you give money to adult children or adult grandchildren. As long as you don't trigger a tax liability, like, for example, you don't pull money out of your RSPs, or you don't sell a non-registered mutual fund or stock portfolio or seg fund to trigger a capital gain. If you're just moving cash over, no tax consequence on the rollover to the child, then the child, when they invest it, the income that they earn will be taxed in their hands. So a great strategy. Now, if for whatever reason you have clients thinking, I'm interested in that strategy, but I don't want to give my kids a blank check, I would like an element of control. Well, seg funds and GIAs offer a great tool. What you can do is you can set up a seg fund or GIA in your adult child's name, but you name yourself as irrevocable beneficiary. We'll use an example to illustrate this. So we have Ray, high net worth individual, already in the top tax bracket, has significant non-reg assets that he knows that he will never, ever need. He only has one beneficiary, his son, Alan. Alan's going to get his whole estate. He's thinking, well, maybe help Alan buy his first home or buy a cottage, or maybe Alan just had a child and they want the parents, they want to stay home. For whatever reason, he's thinking, well, maybe I'll give Alan some money now as he's starting his family, as opposed to 20 years down the road when I pass away. He says, but I want to have an element of control over this. For whatever reason, I don't completely trust Alan. Maybe his relationship with his wife is on the rocks. Maybe Alan has a gambling issue, or again, mental health or substance abuse issue. Well, here's a strategy we'll call the mortgage or first home deposit supplemental plan. So what Ray can do, again, is he can give money to Alan, set up a seg fund contract or GIA contract in Alan's name. Again, no tax on the money moving to Alan, assuming it's cash and not money from an RSP or is not selling non-reg assets. The income going forward will be taxed in Alan's hands, so income's being available. And there'll be less assets in Ray's hands when he passes away, so less tax at death and less probate fees where applicable, or estate administration fees. Excuse me. And again, Ray's going to set himself up as irrevocable beneficiary. And this is very important, because what this means is Ray has an element of passive control. Basically, Alan cannot do anything to the contract except a fund switch without Ray's consent. He can't collapse the policy. He cannot make an ad hoc withdrawal. He cannot assign it as collateral for a loan. He cannot change the beneficiary without Ray's consent. Now, Ray can set up a SWIP for Alan, so he can get periodic payments, and he doesn't have to approve every payment. Once the SWIP is set up, that it continues without Ray's consent, so he can provide liquidity to Alan on an ongoing basis. But again, if he wants to control what Alan can do with the money or ad hoc withdrawals, he can stop Alan from doing something stupid. So there's an element of passive control, but he cannot stop Alan. He cannot force Alan to give him the money back. So again, an element of passive control, stopping Alan from doing something stupid, but cannot force Alan to pay him the money back. Now, a couple caveats with this strategy, in addition to the fact that Ray can't force Alan to give him the money back, is that if Ray loses mental capacity, nobody can sign off on his behalf or provide consent, not even a POA. Now, unless Ray gets into a tragic accident where he loses capacity immediately, usually what happens is this happens over time. So Ray may go to the doctor and may get diagnosed with early onset dementia or Alzheimer's. At that point, he could come home and talk to Alan and say, listen, I just got diagnosed with early onset dementia. Maybe we should change the irrevocable beneficiary to somebody else before I lose capacity. And that way we can preserve the control and the contract won't be frozen. And if Ray's concerned about what might happen on his death, because on his death, Alan will have complete control of the contract, he can name a secondary irrevocable beneficiary like his wife. And that way, when Ray passes away, Alan will now need the secondary irrevocable beneficiary's consent to deal with the contract. So a great way of gifting now, but having some type of control. It's a great way of also, monitoring how your kids deal with funds while you're alive. You can see the benefit while you're alive. Because again, if you pass away, most people passing away in their 80s, their kids are in their 50s and 60s. No one's going to turn down free money, but that's not usually when they need it the most. And just building on that strategy real quickly, there's a strategy specific to RIFs. And I'm going to talk about the first scenario that we talked about that we thought might apply to it, and then talk about some other solutions where this RIF solution, which we call the RIF successor annuitant strategy, might apply. So think of a situation where you have people in a second marriage with kids from a first marriage. So let's assume I'm in a second marriage with kids from my first marriage, and my second spouse is in the same scenario. And my spouse says to me, says, John, I love you, and if I die first, I want to roll over the RIF to you to provide you with an income stream. But then when you die, I want whatever's left to go to the kids from my first marriage and not go to your kids from your first marriage because they never liked me, or go to your new wife because I just wouldn't like that. So what you could have is you could have Mrs. A here, my second wife. She could have a RIF with the owner and being the owner annuitant, and she could name me as successor owner and successor annuitant, and she can name her kids from the first marriage as irrevocable beneficiary. So what this would mean is if I die first, she continues with the RIF, no issue. If she dies first, the RIF automatically goes to me. So from an administrative perspective, way easier than if I was named as beneficiary and then I have to roll it over to a new RSP or RIF. Okay, so much simpler. The RIF will continue. I'll use her age or whoever's age was used for the RIF minimum. That might be an attractive feature as well, too. I'll qualify for the pension income credit, regardless of what age I am going forward. And then when she passes away, it goes to me tax deferred. And I'll continue to get the income stream, but I cannot change the policy or make any changes, increase the payments or change the beneficiary without her kids' consent. And then when I die, whatever's left goes to her kids. Now, a couple caveats with this strategy. One, you can't use it with locked-in money. If you're doing a nominee name, you want to make sure that the nominee plan allows for this. As well, as soon as Mrs. A names her kids as irrevocable beneficiary, she too will need their consent. So that's very important. Never name minors as irrevocable beneficiary. And lastly, if she dies first, it goes to me, and then on my death, it goes to her kids. The tax liability goes to my estate. And that may or may not be good. You probably want to plan for that tax liability in my estate. So you probably want to think about that as well. But those are the kind of three caveats. Now, the other situations where this might be appropriate is an example. Let's say I'm worried about, or Mrs. A is worried about Mr. A being taken advantage of by telemarketers or elder fraud, or maybe one of the children is going to be, can be a bit of a bully with her husband. Well, then she might want to protect Mr. A from those telemarketers or from that bullying adult child. And she can name someone else as irrevocable beneficiary to protect Mr. A from himself. And the other one that's really interesting is take the situation where Mrs. A has competency, Mr. A doesn't. Well, if she dies and Mr. A is named as beneficiary, Mr. A's power of attorney can set up a new RIF for Mr. A, but won't be able to name a beneficiary. But rather, what Mrs. A can do is she can name herself as owner annuitant, Mr. A as successor owner, successor annuitant, and she can name kids as a revocable beneficiary. So let's say assume it's a first marriage situation. She dies, automatically goes to Mr. A. When he dies, automatically goes to the kids, avoids his estate. Some great estate planning tools or features there as well, too. I do want to let you know if you do have questions, you can put them in the chat, and I'll try to get to you through email after the presentation as well, as those are the instructions I've received. And the last part, just to finish up here, hopefully with a little bit of a bang, is the GIA. Now, the GIA, I think, I'm not going to tell you what people should invest in a seg fund or equities versus a GIA, but I do want to mention there's a real neat feature when it comes to insurance company GIAs versus bank GICs. I think you all know for non-registered bank GICs, that income is reported as interest income. For GIAs with insurance companies, it's actually reported as annuity income. A lot of people are shocked by that. Okay, so non-registered GIAs, the income is reported as annuity income. And the relevancy for that is for people 65 or older, annuity income qualifies for the pension income credit. So federally, that's $300. And provincially, you see the amount can vary depending on what your province is. But as well, anything that qualifies for the pension income credit also qualifies for pension income splitting. In addition to all those other benefits that I talked about at GIA before too, name a beneficiary, the assets flow outside of your estate, the potential for credit protection. Again, the annuity settlement option, all these strategies that I talked about apply as well too. So you get the pension income credit, federal and provincial. You get pension income splitting. If your spouse is 65 or older and that annuity income goes to their hands, they can too claim the pension income credit if they're not already claiming it as well. And it also, our product, our psych fund and GIA is included in one combo product. So what that means is if you have a client who has $250,000 and $200,000 is in a GIA and $50,000 in a psych fund, well, it'll qualify for the management fee reimbursement. Now, it only qualify for the $50,000 on the psych fund portion, but it does reduce the management fee for your psych funds. It does count towards that MFR refund or reimbursement. One thing I do want to point out, and this is very important, with GIAs, you do get a 1-year tax deferral. So if I purchase it in December 2023, my policy anniversary date will be December 2024. So I'll get a tax slip in early 2025 for my 2024 tax year. So I won't have to pay any income on my 2023 return. I'll only have to pay it on my 2024 return. So I'll give you an example here. If I buy a GIA in December 2023, the policy anniversary will be December 2024. I'll get a tax slip in early 2025 to pay tax on my 2024 return. However, if I wait till January 2024, my policy anniversary will be January 2025. I won't have to pay tax on that income I earn until I file my 2025 return in early 2026. So if you have someone who's thinking about a GIA or a daily interest account at the end of 2023, you might want to think about putting into the high interest savings account until early 2024, and then move it into the GIA or DIA in early 2024 to get an extra year of tax deferral. It can be very, very attractive. Now I'm going to go through, if I have a moment, to go through a very simple example. We have Dan, age 70, Jane, me, 65. She has a $1 million registered GIC, and she's going to think about putting on a GIC versus a GIA. Dan's in a 50% tax bracket. Jane's in a 20% tax bracket. If Dan invests the money, it's all his money, the $1 million. He'd earn $50,000 of interest income taxed at 50%. Well, he net $25,000. A GIA, if you put that $1 million into a GIA, let's say he earns a little bit less, 4.8%, so $48,000 of income, but he can split that income between him and Jane, who's in a much lower tax bracket. Well, the net income after tax goes up by $6,200. Now, I'm not even including the potential for any enhanced pension income credit. So you can see the potential attraction of a GIA versus a GIC here, especially if the pension income splitting is applicable in a particular situation. And with that, I know I'm a minute over. I'm going to pause. I'm going to turn it back to Lisa and say thank you very much. If you have any questions, I'll answer your questions afterwards via email. And again, I hope you have a great rest of your day.